Look at a $500 trading account. Now look at a target of $50,000. Crossing this gap requires a 100x return on capital. Most retail traders fail because they try to cross the gap using linear, high-risk tactics. They treat the market like a lottery. This usually looks like maxing out account leverage or desperately chasing massive, low-probability setups that promise a 1 to 10 risk-to-reward ratio on a single swing. Professionals reach high capital goals through compounding. They keep their risk heavily restricted and roll every dollar of profit directly back into their trading capital to generate future earnings. Turning $500 into $50,000 does not require predicting market direction with absolute certainty. It requires the strict, emotionless execution of a mathematical formula. With linear growth, withdrawing profits keeps your trajectory flat, but roll earnings back and base capital increases after every win. Initially, compounding is slow. A 10% gain on $500 is just $50. Eventually, reinvested capital generates self-sustaining returns, and the curve breaks vertically. Enduring those agonizingly slow early months without changing your strategy is the mandatory psychological requirement for reaching that vertical ascent. You cannot compound a zero balance. The entire engine stops operating if your base capital drops too far. This bar chart breaks down a 5-trade losing streak. Risking 10% on every setup drops your capital into a devastating 41% deficit. But look at the parallel column. By restricting risk to a fixed 2%, those exact same losses result in a manageable 9.6% dip. Here is how you calculate that fixed position. On a $500 account, a 2% risk equals $10. Dividing a $10 risk by a 30-pip stop loss equals a position size of exactly 0.03 microlots. As your account grows through compounding, that strict 2% rule automatically calculates out to larger trade volumes. When you hit an inevitable losing streak, that same 2% rule automatically shrinks your trade volume, acting as a built-in mathematical parachute. Strict position sizing is the structural foundation that allows the math of compounding to function. Defensive risk management keeps you alive, but to move the curve upward, you need a positive statistical expectancy. You need an edge. On the left, a 70% win rate, but because the average loss doubles the win, the trend line is negative. On the right, a 40% win rate, with a strict 1 to 3 risk-to-reward ratio. These larger wins absorb the uniform losses, driving the green curve steadily upward. True compounding relies entirely on the relentless execution of a proven statistical advantage over hundreds of trades, regardless of any single outcome. A pristine mathematical system executes perfectly on paper, but in live practice, unpredictable human emotion introduces sudden, catastrophic errors. The excruciatingly slow geometry of the first few months makes traders bored. They see a $50 return on their initial $500, and doubt begins to set in. That impatience manifests as fear of missing out. Traders begin taking unverified setups or aggressively doubling their risk to revenge trade a recent loss. Breaking the 2% risk rule for one undisciplined trade can instantly shatter an exponential curve that took months to build. Your strategy is only as robust as your ability to stick to it. Psychological discipline is the most volatile variable in the entire equation. Theoretical models ignore friction. The real market does not. Broker spreads, trading commissions, and execution slippage act as operational friction. These small deductions slowly drag down your compounding geometry over hundreds of executions. Trading through a broker with ultra-tight spreads is a mathematical necessity to preserve the integrity of your trajectory toward $50,000. Scaling an account 100x is a data-driven marathon. It requires abandoning fantasies of a lucky windfall and submitting to strict, repetitive process. Test your statistical edge on an FXNX demo account risk-free. When you're ready, utilize our 0.0 pip spreads to maximize the efficiency of your